In April 2026, Meta quietly started paying some creators in digital dollars instead of regular currency. No press conference, no big announcement, just a quiet update to a payout page. And Meta isn't the only one. Apple, Google, Amazon, Walmart, and X have all been exploring the same thing behind the scenes. This isn't a coincidence, and it isn't random. There's a specific reason nearly every major tech company suddenly wants a piece of digital currency right now. And understanding it tells you a lot about where money is actually headed. Let's start with what's real, because this space attracts a lot of hype. In late April 2026, Meta began rolling out stablecoin payouts to a limited group of creators in Colombia and the Philippines. Instead of getting paid in regular currency, they can now receive earnings in USDC, a stablecoin pegged one-to-one to the US dollar, delivered through the Solana and Polygon blockchain networks, with payments firm Stripe handling the infrastructure. Here's the part people miss. This isn't Meta creating its own currency. You might remember Meta tried that back in 2019 with a project called Libra, later renamed Diem, an ambitious plan for its own global digital currency. It collapsed by 2022 under heavy regulatory pressure. This time, Meta is doing something much narrower, plugging into an existing, already regulated stablecoin, not building a new one from scratch. Meta itself has publicly said it has no plans to issue its own stablecoin. So why is this happening now, all at once, across so many companies? The short answer is regulation. In 2025, the US passed what's called the Genius Act, legislation that, for the first time, laid out clear federal rules for dollar-backed stablecoins. Before that, the legal ground was murky enough that most major companies avoided touching digital currency directly. Once that legal clarity existed, the floodgates opened. Since then, companies including Apple, Google, X, and Airbnb have all been reported to be exploring stablecoin integration. Amazon and Walmart have reportedly looked into launching stablecoins of their own for things like customer payments and loyalty systems. This is the least conspiratorial explanation there is. New rules made a previously risky area legally safer, and companies moved in fast, the same way any industry rushes toward newly opened, low-friction territory. Here's the actual business logic, and it's less dramatic than tech giants building their own central banks, but arguably more interesting. Traditional payment systems, card networks, international bank transfers, are slow and expensive, especially across borders. Sending creator payouts to the Philippines or Colombia through traditional banking rails involves fees and delays at every step. Stablecoins solve a boring but expensive problem: moving money globally, quickly, and cheaply without needing a bank in the middle of every transaction. That's genuinely useful for platforms with millions of users worldwide. It's less, we want to control the world's money, and more, our current payment infrastructure is slow and costly, and this fixes that. Visa has reported its own stablecoin settlement network hit billions of dollars in annualized volume, growing rapidly. The financial industry itself is already leaning into this shift, not just tech platforms trying to bypass it. Now, here's where I want to slow down, because headlines about this topic tend to get dramatic fast. Yes, the total circulating supply of stablecoins has passed $300 billion. That sounds massive. But an analysis from McKinsey found that actual real-world stablecoin payment activity in 2025 was closer to $390 billion for the entire year, which is roughly 1% of the figures commonly thrown around in headlines, and just a tiny fraction of 1% of all global payments. In other words, stablecoins are growing fast, and tech companies are genuinely moving into this space. But we're still in the early experimentation phase. not a moment where a handful of platforms have quietly replaced the banking system. The current versions of these stablecoins are also far more tightly regulated and centralized than Meta's original Libra vision ever was. They look a lot more like a faster payment processor than an independent new currency competing with the dollar. So why should any of this matter to someone who isn't a crypto trader or a creator getting paid in the Philippines? Because this is one more step in a trend we've talked about before on this channel. Money becoming more abstract, faster, and more automated with every passing year. Every layer of abstraction, cash to card, card to app, app to blockchain-based token, makes moving money easier and faster, but also easier to spend without noticing. As these systems scale, understanding the basic mechanics behind them, not the sensational version, the actual one, puts you in a much better position than reacting to headlines. This is exactly the kind of shift where staying informed early, calmly, and accurately matters more than getting swept up in either the hype or the panic. Tech companies aren't secretly becoming central banks overnight. What they are doing is building faster, cheaper ways to move money globally, using newly clarified regulation to do it. It's a genuinely significant shift, just not the dramatic one the headlines sometimes make it sound like. If you want to actually understand where money and financial psychology are heading, instead of just reacting to whatever's trending, subscribe. Every week we're breaking down another piece of how modern money really works.